Bridging macro and crypto is the key issue, in my opinion, in modern finance. But we're living through tumultuous times. Implosion, crypto crisis, collapse, meltdown. I'm not quoting from a tabloid, I'm quoting from the Wall Street Journal and the Financial Times. So is this a momentous turning point? What now? What is the financial system going to look like in 10 years' time? I think we're very lucky to have such a terrific panel, and we're all day-to-day involved in crypto in some form or another. So it's really a conversation with people in the business. I wonder, Terry, if I could start with you. You're director and SEO of Matrix, which is just down the road from me in Abu Dhabi. You're also financial director at Digital Finance Group. Could you tell us a little bit more about your business, please?
Sure. So we're a crypto and blockchain investment firm started in 2015, and we're diversified. We invest in protocol development, we invest in project building on top of those protocols, and then we also build and launch our own regulated platforms, of which Matrix is one.
Thanks. I mean, just to get our conversation going, I mean, the linkage between TradFi and DeFi. I'd like to ask you a very basic question, just in the basis of your experience. How do you view Bitcoin and the other altcoins? Are they currency? Are they a medium of exchange? Are they a measure of value? What are they?
Not yet, though they hold out the promise for that. I mean, look, we're living in a digital, globalized world, as many have spoken more eloquently than I can, with increased volatility. And this produces a whole new set of social and economic needs which fiat may not be able to meet, especially in emerging markets and informal economies. So crypto may be able to meet those needs, but it has to mature further. We have to address the scalability challenges. We have to figure out how it fits into the current financial system, i.e. regulation. We need a wider acceptance of the social contract that makes money work, where we all agree that we're going to use this instrument, whether it's seashells or paper or digits.
Right, thank you very much. John, could I turn to you? You're a founder of Dagger Consulting, and I think very interestingly for our discussion, a senior advisor to Coinbase.
Also about to disappear entirely into this very soft chair. So somebody send the police if I... Sorry, go ahead.
Yeah, and you were also involved in Dubai Mercantile Exchange. It's interesting from our perspective in the early days. Could you tell us a little bit more about your business, please?
Well, sure. I mean, I'm here. So first of all, I noticed there's press in the audience. I don't represent or speak for Coinbase, which is a public company in any way, shape, or form. I am head of strategy for Coinbase Institutional. Okay. I was head of strategy for the New York Mercantile Exchange. So I've spent pretty much my entire career in volatile, idiosyncratic asset classes. And I do for Coinbase sort of what I did for NYMEX back in the day. Right. Assist in strategy formation around product design, determination of where we should be regionally, creation of fungible liquid instruments, and specifically around complex derivatives.
I see, okay. Just to follow up on Terry's remark, I mean, Bitcoin is down 42% this year. Mm-hmm. Gold is up 2%. How does this affect, if at all, your view on the role of Bitcoin and altcoins?
So I think looking at performance over a discrete point in time is always useful if you want to make an argument in one direction or the other. So I'm on the boards of several crypto funds that are down materially this year, 30, 40%. Very problematic. They're up 10,000% over a 4-year duration. So it's relative to when you enter and exit the investment. Now, certainly anything being down a 3 or 4 handle is problematic, and you have to take a look and understand where that fits in to the portfolio. But what I get excited about when I see the innovation happening in digital assets is very similar to when I first joined the NYMEX. When I joined the NYMEX in 2004, there were 868, unfortunately mostly men, screaming and yelling, giving crazy hand signals, pricing the world's most important commodity. And my first job was to hire a C# developer and build a handheld trading app to replace the pick cards that they would use. They would literally fill out pick cards every 7 minutes. They throw them into a pit, scoop them up, and take them down to a room to type in. My job was to replace that system with a handheld trading app. And I coded it in C#. I was on the floor testing it to see whether or not I could trade as fast as the traders with their pen and pencils. And someone came up to me and punched me in the back of the head and knocked me out cold on the floor of the most important exchange in the world, I'd argue. People don't like change. So I learned that the hard way. So what I'm seeing right now, I have the honor, I think, of being involved in a second evolution in financial markets. And this movement, where I went from open outcry to straight-through processing, which made the system much more efficient. And we're now moving to real-time margining, real-time straight-through processing. So to me, this is more iterative than revolutionary. So I'm less Pollyannish about it. But it certainly is a natural evolution that will occur over some period of time.
Right. Okay. Thank you very much. Dan, you founded Pantera Capital in 2003. And before that, you were head of macro trading at Tiger Management with Julian Robertson. So it was fantastic to hear about. But you characterize Pantera, I think, as the first institutional investment firm focusing on crypto. Could you tell us more about your firm's activities, please?
Yeah, so my background is as a opportunistic global macro style trader, and over the years there's been interesting trades around the world, but in 2011 I got excited about Bitcoin, and it took a couple years to really get my head around it, but we decided that it's going to be the biggest disruption of our lifetimes, and so we essentially went all in on crypto in 2013, and still doing that. We're managing $6 billion for institutions and individuals in tokens and venture equity.
Thank you. Just to turn the focus of our discussion slightly, let's have a look at the institutional aspect. Have you found that this recent turmoil has affected institutional appetites at all for your products? I think it was all going very well last year, wasn't it? But you're finding a little bit of caution coming into the market now?
Not yet. Maybe it's too soon to see if there is going to be a pullback. The perspective I would have is that institutions have taken 13 years to get here and are just now making very small allocations to the space. So we have, some very massive public pension plans or endowments that are invested, but they're only invested 10 basis points or 20 basis points or something like that. So I think the trade over the next 10 years is all those institutions that are just now putting tiny amounts of money. And that's the hard bit, right? Going from 0 to 1 is hard, but then once you have 10 basis points, it's not that hard to go to 800 or whatever the ultimate number is going to be in 10 years. So I think the institutional flow into the space is a huge part of the story, and it's just started. And an important point to make is most institutions prefer to invest in 10-year venture equity style funds, even when they're investing in cryptocurrencies like Bitcoin or Ethereum. So there is a bit of a kind of sense out there that, institutions are dumping crypto, that's why it's dropping. I actually don't think that's true. Most institutions buy crypto via these 10-year type funds. So I think the money is essentially kind of a one-way valve. It comes into the market and for the next 10 years won't come out.
Right, because that was always the great argument, wasn't it, that institutions are starting to get involved, and that was going to change the ecosystem. Very interesting. Thank you for your comments. Reza, you're the CEO of Atlas Capital. You've experienced a role as an entrepreneur in residence for Kleiner Perkins, one of the most famous Silicon Valley venture firms, and you've also sat on the boards of the Atlantic Council and the RAND Corporation. It's wonderful to have you with us. You're involved in a very interesting project at the moment that we can perhaps get onto in a moment. But you pointed out that since the US left the gold standard, in fact, fiat currencies are also open to great manipulation. We've talked about some of the issues involved in crypto. Could you perhaps amplify on that idea a little bit?
Sure. First of all, I want to thank Raha for having us here, and I'm just surprised you've got my picture from Tinder from 20 years ago, so I don't know where you got that, so we're having a conversation there.
You can just
Done as well.
I'm swiping on your Reza. You look great.
Anyway.
Is it left or right? In a good way. Swipe in the good way.
The long story short is that actually that picture was taken when I was working in Haiti about 25 years ago. And You know, I've witnessed through my career in various countries and various parts of the world, mostly working in failed states as a development officer, that failed state characteristics are now encroaching into the Western world. Whether it's Europe, whether it's the United States, whether it's social divisions internally, whether it's monetary issues, climate-related issues, or just plain old, good old-fashioned geopolitics. And when these things happen, they run the bank of the central governments. They force the governments to print money, stimulate the economy, wage war, defense, and create social order. And so, just as much as any other asset class has been manipulated, central banks tend to manipulate the currency for the good of the country, and sometimes the good of certain sectors. And given that we are now pre-war and pre-social dissent and pre-climate change, as opposed to the 70s when we were after the Vietnam War, after the social unrest, and in a highly inflationary time, there's just undoubtedly no way to really say that there's not going to be some sort of new monetary shift. Now, whether Bitcoin or blockchain is part of it, which I think it is, because those are the rails that allow for financial inclusion and digitization and distribution of assets, or whether asset management constructs that allow you to blend real assets in a liquid form through perhaps systematic trading, which is much more consensus-driven. Those things are the things that I think are the future. And for us, as a collective, it's important to get together and try to solve these issues. Because just as much as people in the financial world have experience, or the central bank have experience, and blockchain has experience, the solution is in not one of those places. It's in a collective program that allows us to collaborate and create stability. And stability will be the new gold, will be the new, alpha is just kind of past tense these days. You know, you got to create wealth preservation and stability. And I think this is an opportunity for folks on this panel and others in the group to really collectively design that.
When we were talking about this fairly recently, you even suggested there was a need for a Bretton Woods III. Could you just expand on that?
Sure. I think Bretton Woods, in '44 at least, was a little one-sided. America kind of developed its own qualifications for what designed, you know, what's the global reserve currency. And Bretton Woods II also was very one-sided. I think Bretton Woods III requires groups of trading blocks, which will likely be split, because now I think we all see the writing on the wall with Russia, potentially China, certainly India, trading amongst each other very important commodities that are part of their national security and homeland security, whether it's wheat to India, which has had a huge heat wave that's destroyed 30 or 40% of its crop, whether it's oil to China, which is reluctant to get oil from the Middle East, which is controlled by the US Navy. These are trading blocks that will likely naturally occur, and settlement systems and currencies will be developed to allow those trading blocks to be sanction-proof and to create monetary stability in those regions. And as we develop those chisms, there needs to be a conversation around what is the collective monetary system. So there's a lot of talk about that these days.
Thank you. I'd like to pick up on a point that was discussed in the panel we've just had the pleasure of having. Dr. Nouriel was emphasizing some of the regulatory issues. And I guess that is probably the greatest area of tension as crypto develops. Dan, if I could ask you, at Pantera, you've launched currency funds, a blockchain venture fund, and an early stage token fund. You must have been intimately involved with the regulators at all stages of that journey. Could you tell us a little bit about how that journey ran through?
Sure. So the good news is most regulators in the world have been neutral on blockchain. There are a few, like China, that have very nationalistic policies, and then there's really only one, the United States, that has fairly opaque policies as to what's a security and what's not a security. So even in the United States, all the other agencies have ruled banks can custody crypto. The IRS allows you to get long-term capital gains tax treatment for owning it. And it really just is, unfortunately, the Securities and Exchange Commission that hasn't laid down any parameters of what is a security and how one should treat it. So for our investing, we just have structured our funds such that we assume everything in it is a security, even though to date nothing's been called a security. But that needs to get resolved. And in the US, they don't have an ETF. So you have really strange things like the Grayscale Trust, which is a Bitcoin trust that was trading at a 83% premium at one point and is trading at a 37% discount now, which is obviously a crazy way to treat retail investors. So the only risk really is the US SEC, and hopefully within the next year or two that gets resolved. There's actually a court case, a company we're investing in called Ripple is in a suit with the SEC, and so a judge will rule on whether Ripple is a security or not within the next 6 months.
Right, right. The BIS, the central bankers bank, recently stated that stable coins work against the public good and undermine the payment system. And it declared Bitcoin in particular has few redeeming public interest attributes. I mean, this is really awful. John, you pointed out that digital assets are designed to be fungible. However, there's a wide variance between the regulatory approaches. Could you expand on that idea?
Well, I mean, I don't know that whole quote, but if they said Bitcoin was a stable coin, they need to learn what they're talking about. I think, look, I think fungibility is, I don't recall saying that, but I'll clarify if I did. I think we're moving to what most people in the industry call a multi-chain world, where you're going to have a couple of these layer one blockchains that people will build interesting businesses on. Not everything is going to become decentralized. Not everything is going to move to a decentralized blockchain, at least in my lifetime. Maybe in my daughter's lifetime, some of it will, most of it will. But I think it's very, very likely in my lifetime we'll have certain activities, businesses. I don't know if you have title insurance here in the UK, but this concept, I just bought a condo in New York, and I sat around a table with 15 people, 2 of which I had to write a check, $5,000 to prove that my condo was mine. So it's an insane concept as far as how do we not know that my condo is mine? So functions like that will shift to immutable sources of truth, which blockchains actually do a pretty good job of. I think then within the blockchain itself, things are impeccably fungible, but blockchains do have a problem, at least now, talking to each other. I actually think that's a really wonderful opportunity for the US dollar. So I think as the world moves off the crude oil, as it depegs the US dollar off of crude oil, and to some degree at least, maybe not as much as Russia would like, I think that the US dollar acts as the lubrication vehicle between blockchains. Now, whether that's a CBDC or a stable coin that's fiat-backed, as Nouriel indicated, I don't believe in algorithmic stable coins. So to me, it's irrelevant. It's a mechanism to transact, whether you represent a dollar as a digital asset that Citibank controls on their own internal ledger, or whether it's some tokenized equivalent that operates on some blockchain that's public. To me, it's completely irrelevant. It's just about efficiency and ease of use between blockchains.
Right, thank you. Reza, would you have any comments on that, John?
Well, I think he's the world's expert at this, so I would say nothing more.
Right.
Wow, I thought wearing
terrific.
these socks was pandering to this audience.
Swipe to the right.
But that is so nice. No, what Reza's doing, and I'll pander right back. What Reza's doing is exactly what is needed to normalize, institutionalize these assets. What Dan is doing by having a large, very regulated, people for 10 years says hedge funds weren't regulated. AFMD, Form P, I mean, it's insane how much, you have to give away more information about your personal wealth than any other private company in the world. So what Dan is doing, what Terry's doing with creating institutional exchanges and price discovery in the Middle East, this is what is going to institutionalize the asset class.
That's right.
Thank you. Well, we'll get on to actually in a moment, Reza, to the very interesting program that you've launched. But Terry, at DFG, manages a great wide range of investment products, including crypto hedge funds and blockchain venture capital. Could you explain a little bit about your journey with the regulators? And I'd be particularly interested in any comments you might have on the Abu Dhabi Global Markets and ADGM regulatory system.
Yeah, I think our experience has been similar to Dan's in that most regulators are interested and looking to learn and engage, most. And, you know, they want to develop policy frameworks that enable this innovation to grow. And that's, for example, one of the reasons why we built our exchange in Abu Dhabi. Going back as far as 2018, it has a clear, stable policy framework. It clearly defines crypto as a commodity, so there's no policy risk. And it gives us a platform to build a global market. I think the one point of difficulty that I've experienced with regulators is trying to understand censorship resistance, which is the fundamental innovation in crypto to my mind. You could call it financial inclusion. There's different ways to describe it. But, trying to balance censorship resistance with consumer protection and money laundering is a very difficult thing to achieve. And I think if regulators are given a choice, they'll always move in favor of consumer protection and money laundering away from censorship resistance. So one of my concerns is as the ecosystem matures, we're able to protect censorship resistance.
Right, thank you. I'd now like to see if we could focus on stable coins for a few moments. Reza, you're very much involved in this area with your own particular project. But could you just talk to us for a few seconds about the whole area of stable coins, what the role is?
Sure. I'm happy to. I mean, everyone knows what a stable coin is, but I would break it up into three categories. One is algorithmic stuff, which I think we've seen the result of that. And there could have been some fixes there that would have kept Luna Terra a little bit more stable, but somehow they didn't close the lid down on it properly. So there might be another attempt down the line, and I don't think the end is nigh for algorithmic stuff in the future. There's a lot of bright people, and algorithms and processing speeds will allow for it in the future. So we'll just put that aside, especially if governance is AI-based. We'll see. The second one is your classic dollar peg, which I find interesting because it allows you to settle quickly. Obviously, crypto arbitrage is based on that. But increasingly, companies across boundaries such as borders such as China and Russia are settling trade between each other. Commodities are being settled, goods, services. So there is a real application of them because it takes 9 seconds to send money. Sure. Versus 3 days, no KYC, no AML, which could be a problem. But it is a very efficient and liquid way of using the dollar. What my challenge is with it, of course, is that it's pegged to the dollar, and if you had a stable coin last year, you lost 7.5% against Bitcoin or any other asset for that matter, or this year you might lose 10, 15, 20. Next year you might lose more. And so it doesn't seem that if you're pegged to the dollar that you could really argue in a highly inflationary environment with de-dollarization that these are really stable instruments. And the third one will be ultimately an asset class which we ascribe to, which is one that involves the dollar but protects it against with negatively correlated assets. Think gold, an asset class that traditionally in the last 50 years since we depegged against we unpegged against gold has been negatively correlated to the dollar. Think real estate, another asset class that goes up when the dollar goes down. And now with a liquid asset allocation construct and asset management systems, you could arguably create those negatively correlated assets to support the fall, as gentle as it may be or not, of the dollar. So that, I think, will be the emergent stablecoin business that, as the dollar loses its value, will become more relevant.
Right. Any other members of the panel like to comment on that?
Look, Reza's exactly right. He's in very good company. It's publicly disclosed in the Form ADV. I was on the board of Tudor when Paul Tudor Jones decided to include Bitcoin and some other cryptocurrencies as part of his long-term inflation hedge. It's one of the world's leading commodity experts that made this decision several years ago. So I think more and more folks are doing the same analysis and realizing that it works, not on a standalone basis. It's not a perfect inflation hedge. Dr. Nouriel is correct. But as part of a basket, it is a more effective solution. There's no good inflation hedge.
And it will likely include Bitcoin because it is like gold, a scarce commodity. The challenge with Bitcoin now is that it's highly volatile. It's thinly traded. Its concentration of holders are quite high. Mm-hmm. So as those assets become more diversified and more stable, they certainly could be a basket that ultimately will include Bitcoin.
And the important thing, you're absolutely right about everything. Just certain commodities we hold dear. So the cotton market is controlled by about 9 Brazilian families. So right. the one thing that I'm a cynical enthusiast about crypto, and my cynicism comes from some of the participants more than the underlying technology because they're crazy and delusional. My enthusiasm comes from the fact that I was in one of the craziest asset classes for most of my career and realized just don't be hypocritical. right? You're right. There's a high Gini coefficient. There's a high, absolutely. Look at the cotton market. Look at the palladium market. Look at any of the markets I oversaw as head of strategy for IMX. These crucially important markets are as concentrated, as potentially manipulated, and we rely on them every day. So if we're going to have this concern about Bitcoin, that's fine. It's rational. It's reasonable. Don't be hypocritical and have that same concern about these very, very crucial commodities markets that run our entire industrial ecosystem.
But I mean, the problem with Tether is that there's some doubt as to what actually the backing is. I mean, it's wonderful if it's going to be pegged to the US dollar, but who's going to check that it is? And I mean, subject to fines, the management structure is extremely gray in the Tether.
What do you think?
Dan, would you like to comment on this?
Yeah, I guess the point would be stablecoins are massively important because the existing financial plumbing is terrible. SWIFT, right? The Society for Worldwide International Financial Telecommunication. Wow, that's so 1960s. It takes 3 days to send money with SWIFT. FedWire, the United States is supposed to be so sophisticated. It takes 3 hours to send money from Goldman Sachs to JP Morgan. Stablecoins, you can send money instantaneously to anybody on earth with a smartphone. That's a huge thing. That's why China already has a stablecoin that's bigger than all other private blockchains already. They have 300 million people using their stablecoin. The Federal Reserve's building a stablecoin. So stablecoins are here. There are a couple different varieties. There are ones like Tether and USDC that are supposedly backed by treasury bills. Tether probably isn't, don't know. But ones like USDC are, and they're audited, they're examined, they're completely bulletproof, they're great. And then the failure of Terra, the one point I would make is it's kind of like the dot-com era. Like people will use this new technology, they tried some things worked, some things didn't. And Pets.com's failure didn't mean the internet was stupid. It just meant that business model wasn't right. And Terra's failure means that one particular way of doing an algorithmic stablecoin didn't work. But it doesn't really say anything about blockchain.
Right. Before we move away from stablecoin, Reza, could you give us a few words on your incredibly interesting project in this area?
Why I kind of alluded to it in the third category of stablecoins, which is we're building an asset class which takes negatively correlated assets, as I mentioned, U.S. Treasuries against gold and real assets, like real estate investment trusts. These real estate investment trust stock, which are liquid and traded on the New York Stock Exchange, are exposed to properties that are in areas that benefit from climate change and migration, so highly resilient geographies, and therefore areas which will likely be areas of migration in the long term. And as migration patterns shift to those areas, the price of those assets go up, notwithstanding the fact that they're real assets and they go up traditionally during inflationary times. And with gold and real estate kind of covering the losses against the U.S. Treasuries that we hold, that basket of instruments that are liquid and are systematically traded, and we work with Goldman Sachs to do so, will be expressed in the form of an ETF. And that ETF is regulated. It's based in an onshore SEC-regulated environment. And then the expression of that strategy in the ETF, or that ETF itself, is digitized as a security token and sold as a stable store value. And so that's essentially it. It's called Atlas. It's an acronym. It stands for America's Trust for Land Acquisition and Settlements. It's a little better than SWIFT, I think. But anyway, it's designed as a sovereign wealth fund for the North American environment to create monetary stability to fund food and water security in communities.
Well, that's fantastic. I'd just like to move on to another category, and Terry, I'm going to ask you about this, but central bank digital currencies, actually supported by the BIS, and the establishment wants to take on the decentralists at their own game. Could I ask you about the role you feel these vehicles, central bank digital currencies, are going to assume?
I think central bank digital currencies have the potential to become the Frankenstein of crypto. All of the transparency and traceability that crypto offers could be used by central banks in extremely repressive and negative ways. That's not what BIS has in mind, but I think the potential is certainly there. So my previous comment about censorship resistance and protecting that is thrown into sharp relief when you start to talk about BIS-led central bank digital currencies. I think they have a role to play, particularly in the financial plumbing when it comes to bank settlement and intraday payments and that kind of thing. But on a retail level, to imagine that a central bank could simply put a hold on your account or could monitor all of your financial transactions from the cup of coffee you buy to the home you buy. There's the possibility for an extreme invasion of privacy there that's quite concerning.
Right. But we're getting onto geopolitics a little bit. I mean, when we think about the digital yuan, for instance, and China trying to loosen the US role on the financial ecosystem. Reza, would you like to comment on this? If you compare digital yuan,
well, I
the
mean,
dollar.
like I said earlier, I think if you have a bifurcation of the monetary system as a whole, you'd have to represent local currencies, especially local trading partner acceptable currencies. The renminbi being what it is and being a good chunk of the GDP of Asia, it's a natural. The renminbi has been toyed around with on the blockchain, hasn't been very successful. But I think as China understands that its own currency, which is a little bit of a free fall right now, needs to be stabilized, it might bring in other assets. And they've been buying gold at a scale that is unprecedented. And if you shore up your treasuries or your renminbi with gold, there may be some sort of stability play there. But ultimately, it will run off the blockchain. There's no question about it. Paper money is going to go away. And systems like SWIFT will likely get hacked in an adversarial, asymmetric war game scenario, likely. And so you're going to have to back into blockchain, and you're going to have to back into it in a way that not only provides the stability of the distribution and the liquidity of the asset, but also in the actual backing of it. Right. So I think there's a lot of room for play there, and I think the United States is rightfully concerned. It's done a couple of things that kind of push the other side into creating this adversarial environment, but it's a Game of Thrones right now.
Right. Well, thank you. Well, look, we're practically out of time. So would anyone like to ask our very distinguished panel any questions on this amazingly interesting topic? One hand over there, I think. I like that.
Thank you very much for the insightful information. You mentioned a couple of times that it's obviously going to be the future of blockchain and cryptocurrency.
That what? Sorry, what will be the future?
That you mentioned a couple of times throughout that this is not going to go away, cryptocurrency, blockchain, and so forth. How long do you think it'll take till we are in the position where all the skepticism is gone and it's been accepted, and it's almost like going to a supermarket and paying your groceries with cryptocurrency without any problems whatsoever?
I don't think you'll go to the supermarket and pay with cryptocurrency. So I'm sorry I don't want to be aggressive, but what do you mean by accepted?
Well, because there's a lot of, like you said, there's a lot of skepticism around it, right? And every single time you hear about hacks, there's always volatility in the currency. There's always something that fails to have people adopt it, right? So, in your opinion, when do you think that will subside?
So I'll throw out one thing, and I'm guessing it'll subside right when your duration of your fund ends. So that way you can get out good. So in the next couple, let's just go lowest. We always talk about these like going to the supermarket, replacing the US dollar. It's not going to happen in my view. But in the next couple of years, what sport do you like? What's your favorite sport? Do you have a favorite sport?
Formula One.
Formula One, okay. When you go buy a ticket to a Formula One in the next couple of years, you will not get a ticket. There'll be no more tickets. You're going to get an NFT. Now, that NFT will prove that it'll remove fraud from the ticket process, which is one thing. It'll prove you were at that Formula One event. Marginal value, right? Who cares? But let's say at that event, Lewis Hamilton breaks the world record. I don't know Formula One. I'm going to sound stupid here. But he breaks the world record by like 10 seconds, okay? Now, maybe there's a little more value to that NFT because you can now trade it, right? That's maybe interesting, maybe not, who knows? But then let's say embedded in that NFT is a smart contract that is a lottery ticket. And once every 6 months, it activates, and Lewis Hamilton calls the cell phone of whoever owns it and talks to you for 5 minutes. Now that has real value. So that kind of stuff, I call that the lowest common denominator use case. Entertainment, things like that. The Kim Kardashians of the world, I mean that with all due respect, are going to figure out ways to incorporate interesting stuff into this technology. Call it a store of value, call it a currency, because you can probably trade it with your friends. I don't know what that is, but that's going to be a huge part of your life. It's coming, whether you like it or not. Just like my mother hates using online banking. If you hate using NFTs, get used to it. If you want to go to any sporting event, that's the reality. How long before you can pay for groceries in Bitcoin? You can do that today. It's up to the grocery store. Now, they usually don't take Bitcoin. They just have a front-end company that converts it into cash. But it depends what your goal is. But all of this stuff is happening in the next, in our lifetime.
Thank you.
One question over here, I think.
This is going to be a tough one. This is the guy who asked the tough questions. So Reza,
It's on you.
John, you can relax on that one.
Taking this off.
Reza, my question was around custody. So I think we haven't really touched on custody of reserve assets. So in the sense that Bitcoin, if imagine was a reserve asset, one of the good things about a sovereign out in a developing country, sovereign in particular, would be that they custody their own reserve, which was something that Russia found out about the $500 billion that they had. They didn't actually have that. So in terms of your project, which would be a reserve, potentially be a reserve asset, if I understand correctly, why would I want something that's backed by North American property, which is not just not custodied, but not custodiable without an invasion of the country? For a country outside the US to hold this as reserve asset feels really, from a political perspective, quite weak. Would you comment on that?
Sure. I mean, right now you hold worthless paper that is based on the full faith and credit of the United States. So I think real estate is a better alternative. Certainly gold and Bitcoin is as well. So I think it's just about the alternative at the end of the day. And so I venture to guess that that's probably the decision that I would make if I were to try to hold one form of asset versus the other, whether it's the credit of the United States versus a real asset that the private sector owns in a regulated liquid form that's on an exchange that's been around for a couple hundred years. There might be a third better alternative that Dan's investing in these days, but we're not there yet. So we can make the transition though ultimately over time.
I think we've probably got to finish now, but I'd just like to ask the panel in 2 seconds, where are we going to be in 10 years' time? Terry?
I'm not sure. I can't look that far ahead.
Where are we going to be?
Where are we going to be in the crypto world in 10 years' time?
I'll take that. I think most people with a smartphone are going to be using crypto in 10 years. So literally billions of people. And one piece of good news for the gentleman who asked, what's it doing? 10% of all U.S. to Mexico remittance already goes over Bitcoin. It's saving migrants an entire month's wages they used to pay to Western Union. So Bitcoin is already helping literally millions of people. But that's good news, so newspapers don't write it.
Thank you. Okay, well, thank you very much indeed. Big hand for our panel. Thank you very much.